Ladies and gentlemen, our Team P is going to initiate the coverage of the Moscow Exchange, i.e. MOEX. We issue a buy recommendation with a 12-month target price of 173 rubles per share, implying 27% upside from the current stock price. We see MOEX as a compelling investment opportunity thanks to a number of factors, including unique defensive business model, the vertically integrated structure that addresses potential competition issues, and MOEX corporate innovative spirit that is coupled with experienced management, transparent corporate governance, and attractive dividend yield. We believe the market overlooks the exchange new points of high-quality growth and puts too much weight on the non-core interest income's downward dynamics. Our buy recommendation is based on in-depth investigation of the exchange's business model, macroeconomic environment, valuation of the intrinsic value, comparable analysis, and investment risks review.
Moscow Exchange presents a mix of service-oriented and balance sheet-driven business, as it earns fees coming from primary activities and interest income from client funds. Core markets in which MOEX operates include counter-cyclical FX and money markets and pro-cyclical equities, fixed income, derivatives, and commodities. In this context, company stands out among global peers that seek to consolidate missing segments. We believe that MOEX can substitute volatile interest income with high-quality commission streams by introducing new services and increase fees and commission share from the current 44% to 61% by 2020. In addition, non-cyclical clearing, depository, settlement, information and technical services allow the firm to be a one-stop shop for financial market participants and defend its market share from potential rivals. Four key factors contribute to Moscow Exchange being attractive to shareholders. First, the exchange free float is 61.9%, which is the second highest one among Russian companies. Furthermore, MOEX distributes as dividends at least 55% of its net income. However, historically it paid out even more than was required by its dividend policy. Moreover, company's top management team consists of 5 members, each of whom has more than 15 years of professional experience in financial markets. The supervisory board includes 12 members, with 6 independent directors. Finally, transparent corporate governance and the Exchange Council, which represents market participants, allow developing of the exchange infrastructure in accordance with the market needs.
MOEX is a key beneficiary of the anticipated Russian economy rebound. Inflation slowed down to 5.4% in 2016, making it possible to achieve a target of 4%. Stabilized low inflation provides supporting grounds for CBR to reduce key rate and consequently provides a downward trend of lending rates. This will stimulate growth of loans, uplift in industrial production and investments. Overall, we expect Russia to move to a growth stage in 2017. However, in the context of the sanctions, low oil price and absence of structural economic reforms, the growth rate is expected to stay in the range of 1–2%. Currently, the Russian financial market is considerably undervalued, representing a 42% discount to other emerging markets. However, a reduction of geopolitical tension and improved relationship between Russia and the West will result in a lower Russian risk premium and improvement of foreign investor sentiment. Complex nature of Moscow Exchange requires a separate analysis of each business segment. Starting with the interest income, the main factors here are changes in interest rates and size of the investment portfolio, which consist of client funds and MOEX own capital. The funds are placed in short-term FX and ruble deposits, current accounts, securities, and repo. Interest income previous year's growth is attributed to increase in the interest rates and client balances by 87%. However, we estimate 2016 interest income to drop due to 24% decline in client funds. In 2017, we expect a further decrease caused by the introduction of common collateral that allows pooling collateral funds between FX, securities and derivative markets. Later on, the trend is forecasted to reverse, with trading activity growth outweighed ruble interest rates downward movements.
Moving to the core markets, we should point out that during the last 4 years, FX and money markets represented major sources of MOEX commission income. As for the latter, due to uneven liquidity distribution among market participants and low interbank trust level, repo with central counterparty is expected to remain in demand as it enables participants to reduce the risk of non-delivery and boost repo efficiency. A nearly monopoly position of MOEX on a growing money market with additional demand coming from corporate clients will allow the segment's fees to deliver CAGR of 15%. As for the FX market, we expect stabilization of trading volumes due to the exchange rate volatility leveling off and moderate forecasted growth in all export volumes. As a result, only 2% CAGR of FX fee income is forecasted. Entering a new stage of the national economy growth, we expect equities, fixed income and derivatives market to fuel revenue growth of the exchange. A steady gain in the activeness of local retail investors, prompted by government incentive programs such as bonds tax exemption, individual investment accounts, accompanied by the future growth of the Russian equity market capitalization on the one hand and issuance of the Russian sovereign bonds on the other to finance budget deficit, will drive securities market trading volumes. We forecast commission CAGR of 18%. We foresee that evolving stock trading is likely to bring positive dynamics to index derivatives turnover due to their significant correlation, thus becoming the main driver of the derivatives market during the upcoming years.
MOEX is a high-margin, cash-generating business with low capital expenditure requirements. Nevertheless, to mitigate over-reliance on dividend assumptions, we issue our recommendation as 50 to 50% of DCF and DDM results. Our free cash flow forecast is based on the analysis of the core markets and interest income drivers combined with the estimation of MOEX staff-related costs, D&A, and other operating costs. We incorporate both financial analysis and information about continuing optimization programs of the exchange to arrive at operating income growing at 10%. Estimating ruble-denominated cost of equity, we use Russian sovereign bonds, including premiums for country and currency risks. Using estimated market beta and equity risk premium to arrive to cost of equity of 13.5%, we calculate terminal growth rate at 4.2% as a product of our forecasted 20% retention rate and 21% return on equity. We believe, given its monopoly position, the exchange will sustain its ROE in the line with international peers and significantly above cost of equity. DDM valuation analysis yields 12 months target price of 180 ruble per share and DCF based target price of 166. Thus, our buy recommendation with 173 ruble per share implies 27% upside in 12 months. We performed comparable multiple analysis to check the feasibility of our results and compare MOEX to the international exchanges. MOEX current valuation with 12 forward PE multiple appears at a discount of 27% to the emerging market PEs. While MOEX model appears superior in terms of business diversification and vertical integration, valuation suggests a sizable 12 months upside of 29%, even accounting for Russian financial risk of 17%. Monte Carlo simulation for the MOEX 12 months target price support the buy recommendation in 58% of cases. Limited downside and high potential for growth provide an appealing investment opportunity.
In conclusion, we foresee several investment risks associated with the business of the exchange. First, macroeconomic risks are characterized by vulnerable and volatile interest income and adverse change in the dynamics of the financial markets. Second, MOEX's complicated business model yields additional risks. Thus, growing demand for products with central counterparty imposes higher credit risk threat. In addition, MOEX's failure to manage liquidity and technical issues could affect trading activity and its reputation. Overall, near-term prospects appear not fully priced in by the market, taking into account built-in risk mitigants and management's ability to adapt within new environments. We view MOEX as a long-term play with a feasible 27% upside in the 12 months and a high growth potential in the upcoming years.